Welcome to the Political Risk Podcast, where geopolitics and insurance markets meet. I'm your host, David Benyon, and I'm joined by James Esdaile, Executive Chairman of BPL. We start the conversation with a crisis update, recorded at short notice after the start of the US-Israeli conflict with Iran last weekend, rapidly escalating to involve the GCC countries. James provides an initial view on what this new war in the Middle East means for insurance markets, touching on marine war, political violence and terrorism on the property side, and of course, political risk business. We then resume the main interview conducted a couple of weeks before the current crisis in the Middle East broke out, looking at the evolution of credit and political risk insurance business, as well as standalone political risk business. We will discuss James's career, BPL's evolving portfolio, the evolution of credit and political risk insurance, CPRI, standalone political risk insurance, PRI, before talking about geopolitical risk, expropriation, resource nationalism, and at the end touching on Venezuela as another political risk case study to watch. James joined BPL in 1997 and rose through its ranks to be appointed as executive chairman in 2022. He's worked throughout the firm with corporate buyers of PRI and financial institutions clients buying CPRI, different products, different buyers with different motivations. Prior to his exec chair appointment, James was BPL's managing director for close to 7 years, overseeing growth while navigating disruptions such as regulatory overhaul, the global pandemic, and the market's increasing digitalisation. In 2004, James was nominated to the board as a director, with just 7 years' experience after joining BPL as a graduate trainee following an international relations degree at University of Westminster. In his early years, he focused on French corporate clients, arranging contract frustration insurance for exporters' short to medium-term business. After the 2008 global financial crisis, he played a major role in claims handling, successfully collecting over $400 million of CPRI claims on behalf of clients, and working to increase banking industry understanding of the benefits of the CPRI product. Before becoming managing director in 2016, James was group director for a decade. In this role, he worked with some of the world's largest commodity traders, serving high-volume and time-critical demands for competitive edge in a crowded marketplace. So it's a great pleasure to get James on the podcast. As such an experienced broking executive, so focused on business that lies at the core of the pod, and great to feature BPL as a dedicated PRI and CPRI broker. In this respect, the firm is quite unique, and as I say right at the start of the chat, our conversation feels overdue. So, in that case, let's get into it.
So obviously it's very early days and difficult to provide any real meaningful update as to how it might impact the market, our market. I suppose that's probably more of an impact to maybe the marine market and I suppose the terrorism market as well. Although when I say terrorism market, obviously we're not talking about terrorism here, but we're talking about a situation where any hits to the Gulf states, whether those entities, hotels and the like have bought terrorism cover or whether they bought wider political violence cover. From a BPL perspective, at least, the exposure that we have on payment basis in the region is really largely with state obligors, ministries of finance in the region, who are deemed very decent credit risks. And for the time being, at least, I don't see any change in that perception in the medium to long term. And one impact will obviously be an inevitable rise in the oil price, which for our market and the exposure it has around the world, an increased oil price, it might not be great news for us here in the UK, but certainly for oil producing economies around the world in terms of their debt service and the like, that can be deemed a positive outcome of these events, if it's possible to use that term. So in short, obviously it's early days. It's probably going to last longer, the conflict, than the instigators would like it to. But I would say that the impact to the market, our market at least, is probably limited at this stage, but it's obviously a situation we'll continue to monitor. In summary, I'd say that in terms of the impact of the crisis on the political risk and credit market, from a non-payment perspective or coverage perspective, I think that, again, it's too early, but I think that the insurer appetite and the possibility of losses would be limited. I think where our market maybe soon to see some claims activity would be on the property side and the political violence and terrorism side of life. And again, that may depend on the breadth of coverage that clients have bought.
Well, James, it's a pleasure to have you on the podcast.
Thank you for having me, David.
Well, I think it's been a bit of a BPL-shaped hole in the guest list. You spent nearly 3 decades at BPL, from a graduate trainee to executive chairman. How would you reflect on that journey? What drew you to credit and political risk insurance back when it was even more of a niche within the city, never mind the insurance market?
Yeah, I mean, it's been quite a long journey and nearly 3 decades, as you say, which is hard to believe. I think 30 years ago, I certainly wasn't one of those people that had any real long burning ambition to end up in the insurance market. But it was the late 90s and the jobs market for grads was not fantastic. It's pretty challenging nowadays too. But I did international relations, and after a year of sort of trying to find a job, a small headhunter said, well, I've found this small broker in the city that does political risk. That sounds a bit like international relations. So why don't you give yourself an interview? And without sort of coining the phrase of another podcast, the rest is history.
Yeah, so for listeners who might know BPL by name, but perhaps not in detail, how would you describe the firm today? What's your kind of core proposition as a broker? And yeah, has that evolved since the business was founded?
Well, it has evolved. I mean, I think in the 80s, the business was established by Charles Anthony and Robbie, and was effectively a wholesale broker in its early days. So dealing with correspondent brokers in Europe and in the US. And the proposition there was largely for corporate clients back in the day. I think really it was around the 2000s where we decided that actually we wanted to pursue a more retail path and have direct contact with a client base for this market. So we did a sort of full U-turn on our strategy, which has proved since to be very successful. So over that journey of becoming a retail broker, I think the way I put it is that we've effectively designed the firm to be around the needs of buyers of credit and political risk insurance. And that's been deliberate. So as a monoline, and unusual in that, doing only that class of insurance has enabled us to really focus and do a deep dive on what the clients need and how the market should develop for their needs. And we feel we offer a first-class client service offering, whether you be a bank or indeed a corporate client. So to sort of summarize where we stand as a business today at BPL is in 2025, we channeled about $800 million of premium net into the market. Current estimates of the size of the credit and political risk market are always notoriously difficult to be 100% accurate about, but our latest estimates are sort of in the order of 5 billion, maybe more. So therefore, we consider ourselves to have a significant market share of 15 to maybe 20%. Headcount wise, we're probably not far off 150. I mean, headquartered here in London, but Paris, which I'll come on to maybe a bit later, Singapore, Hong Kong, New York, and Geneva. So we're quite a complex business for a small business, but it's all we do. And we can hopefully only see further growth in the next few years.
Let's talk about the client base a little bit, which spans, as you say, corporates and financial institutions as well. So how is the portfolio composed today? And what does that mix say about where the demand for credit political risk insurance is coming from?
Well, there's been quite a transformation in the last sort of 10, 15 years, insofar as the majority of our client base, by any measure, are financial institutions, banks and financial institutions, which for BPL represents around 70% of our activity, which I think is not out of kilter with the market in general. So they're looking to buy comprehensive non-payment insurance for their loan books and variety of asset classes that the market can now look at. I mean, the corporate client base, being the remaining 30, is sort of split between large commodity trading clients who also use the market for credit sort of non-payment risk, but also to some degree PRI. And then we have what we describe as sort of capital goods exporters operating in contracts in emerging markets, where we cover contract risk, which is both political and to some degree credit as well.
So some of those 30% that aren't banks or financials, some of those are still buying CPRI as opposed to PRI.
Correct, exactly. And, we started life really servicing purely corporate clients, and they remain a very important part of our business today. And whilst I wouldn't want to see the bank FI business shrink, we'd certainly be keen to see a slight rebalancing in terms of maybe more corporate client users of the market, because whilst PRI has been available and readily available for many years and really was at the foundation of the private market, relative to how many investments and companies there are around the world, it's a relatively underutilized product.
I mean, it's a discretionary product, but
Yeah, we describe it as a Gucci product. So it's not legally required, but it's nice to have.
But I suppose going on the risk environment now, that's changing. When people say something's a necessity or a luxury, it's like it's not really an and or. There's a spectrum of how much something is a luxury. You probably agree with me when you say it's a little bit more of a necessity than it was.
Indeed. It's just convincing clients to consider the risks they face. And most of our client base are very well-established, educated companies that are fully aware of the risks they face in their activities. So it's just converting that to whether they see buying such a product is affordable for them is a key point, obviously, but also something that will respond when it's required.
Let's talk about the banks for a little bit. So major buyers of credit political risk insurance, as you said, the majority of the book is financial institutions and banks primarily among them. What changed to bring that about within the book to make them such big buyers? Are we talking about capital treatment, the Basel rules?
Well, I think the history was that, as I say, the corporate client base of the market, which was the founding client base, particularly the commodity traders active in export finance, trade finance. Gradually, we saw those banks financing those entities actually interested in buying cover so they could support the traders. So effectively, whilst banks were competitors effectively to the insurance market in offering cover, in inverted commas, to those entities, we sort of ended up acting for both sides. And so really the foundation of bank use of the market was on the commodity side of life. And really, ever since, the growth pattern has been extraordinarily good. And you're right to say that that has only been sort of turbocharged by sort of in the early mid-noughties when the Basel regulations began to bite, as it were, in terms of capital rules, that the product, our product, that is, the comprehensive product, was used to and effectively achieve capital relief for banks buying the product. And of course, once that became a noted advantage and real value, the explosion of bank users of the market has happened effectively ever since. And whilst most banks that we deal with have been users of the product for many, many years and decades, there are still banks, financial institutions today getting to know the market and the product for the first time. So we only see the prospect of further growth. I mean, don't get me wrong, capital relief is a key driver, but I think statistically it's still the case that most banks buy the product for risk relief. So from an obligor limit point of view in terms of managing their risk portfolios.
Would you say it's become systemically important for them, and how sensitive is that to regulatory change?
I mean, I think it depends on the bank because obviously their usage of the product alongside, their routine means of risk distribution, whether that be outright sales, etc. For some, they are running very large portfolios in the tens of billions in the insurance market, and therefore any change to its validity or its effectiveness could be concerned. But that said, we think that in the last few years, particularly, the product, whereas in the noughties, it was very much, we designed the insurance policies to sort of effectively act as a guarantee under the Basel regulations. Insurance itself wasn't really referenced in the regulations, so banks and their legal departments got comfortable with that. But I think we find ourselves in a situation now where we are a mainstream and fully overt tool for banks to use. So I think whilst we'd always look to improve the regulatory treatment, as in make it more effective, I don't think there's any fundamental risk to, headwinds to regulatory change making the product less effective. Whilst we started on the commodities side of life, I mean, now the market really can look at, and I don't necessarily want to be quoted on this, although I suppose I'm on the record, but I think that in terms of asset class or lending books within banks, I think that commodities now are probably one of the smaller sectors that we look at, and while still very important, of course, but we're looking at shipping, aviation, leverage finance. So if a bank has a credit risk and the obligor is one that the insurers feel that they can underwrite, then really how that debt or that lending is originated is sort of neither here nor there. I mean, just to put it into context, the market in terms of capacity available has trebled really since the late noughties, and insurers are able now to look at tenors of 15, 20 plus years for the non-payment and the PRI side too, in some cases. So the capabilities of the market really are on a strong foundation.
So moving away from the banks, on the non-bank, on the corporate side, perhaps thinking more standalone political risk insurance, PRI, rather than CPRI at this point. It'd be good to talk about some of the motivations there, but also there's something of a protection gap. So therefore, the challenges of demonstrating the need, the relevance, the affordability of the PRI product.
Yeah, I mean, as I said before, I think the market has been accused of maybe forgetting its roots in terms of its support of corporate clients, which I don't think is fair. But it's true to say that we at BPL are certainly very keen to continue to develop that side of the business. I think the gap you talk about is real insofar as, the number of corporates that buy PRI coverage is relatively low compared to how many companies there are out there with investments around the world. In terms of the motivation, I mean, I've actually just been in France this week visiting our Paris office, where we still have a number of very significant French corporate clients who buy PRI cover for specific single assets in emerging markets. And that's a very long-standing client base who understand the product and the protection it can bring. We'd like to use them as a good example for convincing other buyers, both in France and any other country in the world, frankly, as buyers. But I think the issue can be a perception of the product, as in, is it fit for purpose and will it respond in the event of a problem? The nature of expropriation has probably changed insofar as the chances of what used to be described as a straight snatch in terms of a government literally piling in and taking an asset, as opposed to sort of slightly more subtle forms of expropriation.
So straightforward snatch would be nationalising a mine.
Exactly. Whereas you can get bullying about, license cancellation or just making an investor's life more difficult in a sort of iterative process rather than a sort of overt
and therefore you've got a challenge of the wordings and demonstrating that it is a product that would pay out in certain circumstances.
And I think we can succeed at that. And I think that within the credit and political risk market, which is now, I lose count, and I'm probably get pulled up by my colleagues for getting this wrong, but there's at least 50, 60, 70 markets that are active in the space now. And whilst in theory they are all able to do PRI as opposed to non-payment or comprehensive payment cover, there is a subset within the market that are particularly keen to try and develop the product, the PRI product, and make it fit for purpose. And we firmly believe that that has in many cases been achieved.
I think just going back to what you said about the French office, and you've got long-term buyers of the product who, whether or not the risk landscape and the nature of expropriation risk has changed, within certain sectors, buyers who really do understand the product and they've been reliable buyers for a long period of time. It kind of shows how patchy the awareness is in a way, doesn't it? Because if you've got, I'm assuming at this point, but if you've got buyers in Paris, so let's say they might have operations in Francophone Africa, probably not a massive leap of imagination to assume.
Well done, Dean. Yeah, I didn't breach any confidentiality.
No. I'm trying not to force you on that. And therefore it could be natural resources, mining, extractive industries that they're buying for. I mean, that's a community that I think is really associated with the product and do understand it well. But then you look at some of the other sectors or big opportunities that are emerging, like, for example, you've got carbon trading markets supposed to take off. I've heard it described as like the new cyber insurance within the next decade or two. Enormous amounts of investment that supposedly, because of net zero and everything else, will take place. And it will all have to take place within these emerging markets around the equator where it makes sense to have these projects anyway. If you're going to have this kind of environmental impact or create the amount of energy you want to, you have to put them in those countries.
Yep.
And they are geopolitically or political risk exposed regions. And the types of buyers, some of them will be banks and financials, but it depends, won't be ones that really understand this product. It seems to me that certain sectors understand it well and others don't. And you've got long-term constituencies of buyers, but it's convincing those new sectors that emerge, the opportunities that are emerging as the world changes.
You're absolutely right in terms of, to my point about the gap. I mean, the huge range of investments and the nature of investments and how that will change and operating in the developing world, if you like. I think that it's upon us as a market to join forces. I mean, I'm not necessarily talking about my competition, but certainly BPL are very keen to work with insurers to try and get that message out there, to try and grow this important and traditional part of the credit and political risk market. I think I talk about affordability some of the margins in this business. You could argue that natural resources, the margins of investments, whatever, may afford the ability for companies to purchase the cover, or their board requires it, or their shareholders require it. Other companies, I suppose, have been operating around the world for many, many years and never had a problem. One thing we have looked at in terms of the nature of the coverage is been successful in selling sort of a property damage type cover, whereas traditionally you'd cover the equity investment in a foreign enterprise. You've got to look at it from a risk manager's point of view, where you have a budget or a consideration of how much you spend to protect your assets. And of course, some of that is property insurance, is any sensible company would have and is required. But of course, those coverages exclude political risk, terrorism. And whilst the terrorism market has been very successful on a standalone add-on basis since it was excluded after 9/11, what we've tried to do is take that terrorism cover, property damage cover, and try and make it, to broaden it out to effectively include protection for the asset itself. So if it's damaged or taken. So that's another way at looking at covering a company's investments overseas, and fits from a budget point of view more as a relative proportion of your premium spend on property. How much are you willing to pay in addition to that to write back what's excluded from your property treaty?
I think when people think about political risk, it's emerging markets that spring to mind first. But thinking about geopolitical risk, the evolution of expropriation type risks, resource nationalism, those sorts of topics. So in that risk environment, do those assumptions still hold valid in terms of just emerging markets versus the developed world? And how have risk conversations shifted with clients?
Good question. I mean, I think BPL's strapline in the 2000s was, emerging market risk was our published strapline at the time. And I think that, 10 years ago or so, our two most exposed countries, if you like, would be Angola and Turkey, perhaps. Some people might be surprised to learn that today it's actually the USA and the UK. And I mean, the main driver for that is not from a PRI angle, obviously. It's just illustrative of the breadth of lending activity we can look at for bank clients. So it's mostly driven by that. So I think the focus of PRI customers still is mostly emerging market focused. But I think that it's fair to say that in the current environment, the dynamic world we find ourselves living in means that to what extent is any investment in any country safe from a PRI point of view, and what assumptions of safety and international law or what have you that people rely on.
It would have been more unthinkable if you've got a project that's just involving entities in the US and the UK or the European Union, and there is no involvement of somewhere in sub-Saharan Africa. You wouldn't expect to need to consider this sort of product.
No, I mean, people joke. You say, if you're talking to people who know nothing about our business, and obviously you're trying to make insurance sound interesting and say, well, I'm in political risk, and they say, oh, well, that sounds fascinating. And I go, yeah, absolutely. It's an amazing job and I love it very much. But one of the first things they'll say as a follow-up is, well, Trump must be good for business, or, can you insure against Trump? And I sort of just chuckle and try and change the subject. But I think the point is that level of concern in the developed world at the moment is probably the highest that I can remember it's been. And maybe some of these so-called emerging markets are actually a lot safer than some emerging markets.
Yeah. Relatively speaking.
Yeah, exactly.
Yeah. Resource nationalism and expropriation risk, these are re-emerging as themes globally. We might want to caveat that and say how they've evolved as well over time as risks. But yeah, what's your view on that as a trend, and how are investors, lenders using political risk insurance to manage the uncertainties they have around strategic assets?
Well, probably not as much as I said, to continue that theme, probably not as much as they should be or could be, or we'd like them to be, certainly. But natural resources are, notwithstanding the shift to green energy and the like, I think there are plenty of examples where energy security for certain nations remains critical and therefore very competitive and potentially dangerous for investors. I mean, that's always been a theme. And in terms of trends, I think that there's always been risks around that sector. And you could argue that that's only going to get perhaps more and more tricky to navigate as the years go by. But I think that certainly I'm surprised that we don't have a higher inquiry volume from people And maybe that's our fault for being terrible retailers in this particular, I don't know. But it would seem to me that at the very least to inquire as to whether something, you're not committed when you come and talk to us about what insurers' appetite may be for PRI in a certain country, in a certain sector. And there are some countries that we'd struggle to find terms from insurers. They don't do everything everywhere, but certainly there's nothing to suggest that the value of the product or potential value of the product is going to be diminishing anytime soon.
Let's touch on Venezuela. So obviously incredibly dramatic events just after the new year with the American Maduro raid. And after so long of Venezuela being seen as effectively uninvestable, is it back in the conversation? Are there any PRI inquiries starting to see as capital investment could cautiously return?
Well, David, it's always difficult to talk about specific countries and particularly ones where significant events, and you're right to say that, have happened so recently. But whilst we haven't seen a tsunami of inquiries quite yet, we have had a few requests to look at that and what may be possible. We haven't gone to market in a broad sense as yet, but it's a country, frankly, where we've had exposure before and there have been losses before. And it's obviously still deemed incredibly high risk because although Maduro is gone, the regime hasn't fundamentally changed. But obviously the action was done for a reason. And therefore, if you are to see US companies starting to invest in a big way, then if I was those companies, I would certainly be giving us a call to see what's available.
I mean, everyone's still scrambling, I would say, to assess the risk environment, right?
True.
I mean, whether or not you are Chevron and you're already in the country, or other US oil majors and the US government's trying to persuade them to get in there, re-engaging in a lot of cases. But as you say, we haven't actually had regime change. The incumbent regime is still in power. It just got decapitated.
Yeah.
So yeah, it strikes that everybody, whether it's a Chevron, whether it's the underwriters in this market, just beginning to assess that risk environment.
Challenging.
But watch the space then, we shall see. Thank you very much for appearing on the podcast.
Thanks very much, David.
And that concludes this episode. Once again, thank you to my wonderful guest, James Esdaile, Executive Chairman of BPL. Until next time, cheers, thanks for listening, and please tune in again. I've been your host, David Benyon. Production was by Peter McGill, and Lawrence Durkin made the music.